want to kind of give the folks, especially that are new to me, and you know, a little rundown of who I am. But here's our agenda. I was going to now. My point today is to talk a little bit about, not to talk a little bit. If I do my job correctly, you know, here we go. Hang on. So if I do my job correctly, I'm going to give you hopefully a kind of a business case for why electronic payments reduces fraud. That's my whole angle at this and I've been doing a lot lately with fraud. Hopefully that won't be taken out of context in any way, shape, or form. But, you know, as finance people, and a lot of times on these, you know, I get finance people and I get technologists, a little mixture of both, and that's great. You know, but the thing that we have all in common, you know, I happen to be a kind of an IT person and a finance person all mixed into one, so I argue with myself constantly. Hopefully you're laughing on mute. But the whole idea, even though we may have different disciplines here, is that we're always in tune to ensure that our systems are secure, our processes are secure, especially the processes. Those are the ones that I think are most subject. And then, you know, technically that we're all kind of working together to ensure that people don't steal our money. You know, so that's where I'm going to kind of, that's the angle that I'm going to take this, and that's the whole point. Now, to build up to that, I was hoping to kind of give you a very brief glimpse into what the history of payments are and where they've come. And now, you know, why am I able to talk on this? You know, people have called me an expert. Adrian called me a veteran. I think that was one of the first times. I'm struggling with that, but that's okay. But I look nothing like this picture anymore. I'm much older as a veteran. But I do a lot of writing. I do a lot of speaking. You know, that's kind of my primary job, especially the writing. And I've written a couple of books on automation, both accounts payable and payment. So I'm a lot of fun at parties, as you can probably imagine. Now, the big question I have, Adrian and Haley are who the people that are helping me. We have a poll question right off the bat. Do you know when the concept of credit cards came about? I guess it's more of a do we have that loaded? Because we were talking about poll questions. Oh, we are opening the poll right away. So let's go ahead and open the poll, and then we will, you know, whoever is administering the poll, I guess that's Adrian or Haley, whenever it's appropriate to close that, you're welcome to close it. So, folks, right off the bat, I want to hear from you. I want to hear what, you know, when do you think? Just select a date, and as soon as we have kind of a critical mass, we will publish that. And there it is right there. So let's see what it says. So it looks like, you know what's so funny about this? So we're going to get to this answer in just a minute, because it would make a lot of sense if I actually knew the answer, wouldn't it? But I don't know what the answer is, so we'll get to that in just a minute, and hopefully I'll remember when that was. So we'll go ahead and give me back. This is starting off very well for me, so I appreciate everyone. Hopefully you're all laughing and thinking, well, what is this guy up to? So anyway, the evolution of payments. So that was the very first question, is when was the concept of the credit card? When did it come about? And so we'll get to that. And so there we go, right off the bat, 1887. I don't know who answered that in the in the poll question, but you win a prize. I don't know what that prize is. Probably me talking for another 45 minutes here, or 30 minutes. And so it came about. So when we were researching this, you know, just to kind of poke some fun at the history, 1887, the idea of a credit card came out in this book by Edward Bellamy. And then, you know, electronic payments were born in 1918. I'm going to go through this fast. An actual physical card, bank card, was used in 1946. And then in 58, American Express came in and started its things with the charge card. And then the ATM network was created in 68. You know, we're going through this quickly. And in 72, ACH emerged. And, you know, I've written a lot about, can you believe it? You know, the whole ACH process started about because bags of checks were being exchanged by banks, you know, at these secret locations near airports, you know, because they had to exchange them. And then the ACH process came about in 72, and instead of bags of checks, it became tapes. And, you know, I got to tell you, just as an aside, and I know I'm probably spending too much time on this because I need to get to kind of the point of the webinar, but one thing when we talk about electronic payments, people generally think ACH, and that's becoming less and less pertinent. You know, hopefully, you know, in order to do a webinar that's worthwhile, you guys have got to learn something. You know, and I know that sounds kind of crazy, but also if I want to do one where you're engaged and you're intrigued, I need to do some drama, and around ACH is where I'm probably going to concentrate some of my drama. By the way, I'm a big fan, but it was created in '72, and it hasn't advanced an incredible amount since that time. It's still kind of maintained in somewhere in Virginia, and it's still kind of working on that older technology. But anyway, we'll go back and talk a little bit more about this, because when I talk about electronic payments, generally that's what people have a tendency to think that I'm talking about is with these ACHs. But there's some alternatives out here, and kind of build to that point. So in '78, the first debit card was created by Seafirst Bank, and then in '81, the idea of B2B transactions. Now, when I was doing research for this webinar, I thought '81, that seems awfully early, you know. But B2B transactions were created, and in 2009. MasterCard introduced the idea of the virtual credit card. Now, I do want to pause here for just a second, because this is going to set me up nicely around the fraud conversation. And I wanted to introduce the idea of a virtual credit card. And so for those of you that don't know what one is, you know, really, if you kind of look at the words here, it explains exactly what it is, but my mom told me never to, because she's an English teacher, never to use the actual words in a definition. So I got to go beyond that. But the way this came about, so in 2009, there was an actual need to create these virtual credit cards, and the way it came about was more in the consumer market, which a lot of things come about in the consumer market, and then the business world kind of borrowed it. But the reason it came about, and by the way, the reason I'm sticking on this is because, like I said, it's going to set me up really nicely for our conversation about fraud and preventing fraud. But the way that this kind of came up, and the way that it works is that you have a credit card, and with that credit card, it's considered a master account, and then you can create these sub accounts underneath this master account, and each of these sub accounts have a unique number. So if you look at this card, it has 8360 and on. You know, that's the unique number that is associated to this master account. I'm telling you all this because there's some very valuable properties that this kind of sub account or this virtual credit card actually has. And one of the primary properties that it has that makes it a wonderful vehicle for reducing fraud is that it doesn't have any personal information attached to it. And so what that means is that if you've ever had your identity stolen, which I hope more than anything, there's nobody on this phone that has had that happen, but it wouldn't shock me, based on the size of the group, that there would be a handful of you that have. And it's a terrible thing, but that generally what happens is you're able to get personal information, say from you know, your typical credit card or even, you know, any kind of information like Social Security number, and that allows you to open up additional line of credits, and you know, voila, your money's gone and your credit's ruined. And I know this has taken a horrible turn on this webinar, but with virtual credit cards, because it's attached to a master account, there is, and the card numbers are unique, is that there's no way that anybody can steal your personal information. So in early 2009 and on, the consumer market used it because, you know, transactions on the internet, especially with things like Amazon and eBay, especially eBay, where you're transacting with other individuals, it became more and more prevalent that they would use these virtual credit cards to transact because you couldn't get the personal information, you know, if the card was stolen or anything like that. They are virtual, which means that there's technically no plastic created. It's just a number with a dollar amount associated to it. Now, there's two ways, again, I'm sticking on this a lot because, again, it sets me up pretty well when we want to combat fraud. One is there's no personal information, which is a big deal. But the other thing is that you can make these cards very restricted. And generally, what makes them very restrictive is that you can note that they can only be used once. Now, that's an important thing. So now there's no personal information, and you're sending it to a supplier or a vendor or transacting with someone on the internet, and they can only use it once. So once it's been used, even if, let's say, the card was created for $1,000 and the person you sent the virtual card to, all of the information to, takes 900, they can't go back and get the 100 because it shuts itself down. So it's very interesting from that respect. So no personal information. You can create it to where it can only be used once. And so hopefully you're seeing where this angle is coming from, because when you do things like that, you make it very restrictive, and you kind of, parse out a lot of the options that are available for a thing like a credit card. Then it puts you in a really good situation to kind of dictate, who, what, when, what amount needs to be paid. So I'm going to come back to that because I know that can be a little confusing. What are you talking about? Am I using it to pay someone else, or are they paying me? So I'm going to give you more clarity around that. But we found, now for those of you that don't know, I was one of the 6 individuals that started AvidXchange, which is an accounts payable and payment automator, and we became extremely intrigued by this idea of the virtual credit card and the idea of creating a network where vendors could say, yeah, I want to be paid this way. And I'm going to talk more about that because the network can become pretty powerful. And the idea here is that vendors proactively sign up how they want to be paid, and this idea of a network. And you might be hearing some rumblings around this because there's a lot of talk about using portals and self-service portals where individual vendors can go and kind of say, here's how I want to be paid. Here's my I always get these confused. My W-9, I always get that confused with an I-9. I know this webinar is being recorded. I probably shouldn't say something stupid like that. But anyway, where they can post their insurance information and all of that, those are becoming very popular. And so, we see some great benefit in the idea that if vendors kind of tell the world how they want to proactively be paid, and we store it in a centralized area, then folks like you that are on the phone can access this centralized area and have great benefit from it. And I'll explain that a little bit more, because that, as it pertains directly to fraud, that's kind of a big thing in the payments world. So I'll get back to that. Now let me set the stage a little bit as far as payments are concerned. Now this is a survey that was put out by the Association of Financial Professionals, a nice little group, and they surveyed and we're going to see a couple of slides on this just to kind of set the stage, that the use of checks in B2B payments is falling, and you can kind of see that. In 2004, it was 80%, and then in 2013, it's more like 50-50. But I want to stick on this for a little while, and of course, would love to hear from you folks. If you have any questions or any comments about that, would love to hear, maybe put a little note into the chat section that, yeah, we're at the 50-50 mark, or we're more at the 80% mark. But the thing is that I'm one of these folks that are always a little bit wary about statistics, and of course, I deal a lot with numbers, and one of the things that when you look at a kind of a blanket survey, you don't know what types of companies that this survey is communicating with. Well, I guess if you had the actual whole survey, but let me, again, all webinars should have a little bit of drama. Maybe this is some of it for me. And that is, I found, even though, in 2013 it's 50-50, and you can obviously see a trend more towards electronic payments and more towards this idea that, the paper checks are kind of a thing of the past. You can see a trend like that, but one of the things that I always like to point out is that and this is typical with the companies that I work with, is that they're more middle market companies. So let me kind of explain that to give you some context. And that is, companies that are under $1 billion and over $5 million, and I've heard it defined other ways, but that's kind of the way that I look at it. You know, it's a pretty broad range. It represents about 87% of all the employers within the United States that sit in that area, over $5 million and under $1 billion. That's what I consider the middle market, and that's a lot of companies. And if you look at anything that's over $1 billion, those companies that are over $1 billion, you know, they have very large initiatives to become very focused on, you know, getting electronic information and dealing with electronic information. You know, the scale that they can operate at, you know, and the return on investments they have that they can operate at are considerably larger. But anyway, to this point is that I've noticed that with the more medium-sized companies, the more mid-market companies, again, you know, the companies that operate in the vast majority of organizations in the United States, I haven't found that they're at this 50-50 mark, and they're doing more checks than they are, you know, electronic payments. And some of the electronic payments that they're doing are payments that they have to do. You know, their agreement with the supplier or the vendor or the business partner or you know, says that you have to send it to me this way, and it has to be kind of in this mode. And so I found that this number can be somewhat deceiving. It's still trending downward, but the challenge is, the big challenge is getting vendors to adopt. Now, to that point, continuing on with a little information, and now I've introduced a pie chart into my demonstration. I think I'm doing really well so far. So the same survey asks suppliers what if they were more likely to take an electronic payment or a paper check, and you can see that suppliers are very likely. You know, they're interested. They're very interested in this, and of course, you know, there's some good reason for it. And one of the biggest reasons, you know, not having to deal with the checks is not having to go to the bank, and that the money is right into their you know, bank account. So there's some benefits and speed to that, and also if it's electronic, it makes the reconciliation process. Now I want to give you a glimpse back, kind of going back to this idea that vendors are more willing and likely to take an electronic payment. They desire that also. We have a team that it's a large group of folks, and all day long it's about 80 people. I'll put a number to it because to me that seems like a large group, because their single task is to call vendors that are not in our network and ask them if they want to be paid electronically. And there's basically four types of electronic payment. You know, it's not just ACH, which exists, but there's four types, and basically these people, their job is to, and they do a great job. Their job is to call and educate the vendor on the possibility of an electronic payment. And we found out that when we asked them, kind of contrary to this pie chart, this happens to be our own internal data, we asked them if they will take an electronic payment 60% of the time, and they say yes. And so that's you know, one thing that we're finding out here, and by the way, just to kind of give you some scale to this, is that we make 650 calls every single day asking that simple question and doing a little education. And that hopefully I'm kind of giving you an idea of the situation, and I'm giving you kind of I'm trying as hard as I can to craft out the problem. And the problem is, you know, we make 650 calls a day. The problem is, anyone on this phone, you know, you probably have, and I hate to say it this way, but you probably have better things to do than call your vendor and ask them how they want to be paid electronically. And even worse than that, the situation is, even if you do kind of get fired up about it, which I've known some folks to do that, even if you do kind of get fired up, oh, I shouldn't talk too Southern, even though you do kind of make it an initiative and say, this quarter we're going to make these calls and convert these many people to ACHs or to some kind of direct draft or something like that, even if you do kind of get that it's on your radar. The continual nature of it, which is you have to call and call and call, and then of course the impact of the education is, well, you want ACH or do you want a direct? What's the difference? That process just seems to be too much labor for people to take on. I always like to say this. For those of you that know me, I have 4 kids. And when you have 4 kids, your life operates a little bit differently, right? I was telling somebody recently that when you have 4 kids, you don't go on vacation. You just take everything that you're doing in one spot and move it to another spot. By the way, even if you have 1 kid, that could kind of be true. But definitely when you have 4 kids. So, the idea here, going back to this point, yep, there is a connection, I promise you, that you have to, in business, like with kids, you have to pick and choose your battles, and I hate to kind of say it that way because we're not at war here, but the point is, do I get the payroll out, or do I call the vendors? Do I reconcile the bank account, or do I need to go ahead and help these folks with this audit, or I need to start the escheatment process, or do I need all of those things have a tendency to take a heavier precedence over calling vendors and saying, how would you like to be paid? So hopefully I've kind of scoped that out a little bit for you. So the dynamic here is that it's true. Checks are falling. Paper checks are falling. Businesses have a desire to get onto electronic payments. And then when you talk to the suppliers, they want electronic payments, but there seems to be kind of a disconnect. So let's do this. So Haley or Adrian, I don't know who's running the polls. I wish I was a little bit better suited. So can we launch that poll that says what would be the main reason you want to automate payments? And so if you can just kind of see the screen here, you can just basically make out there's a couple of options here. Now, by the way, you're gonna want to probably check other, but hopefully you'll kind of improve business performance, reduce costs, increase visibility. What is it that would drive you towards electronic payments? So let's check that out. And of course, when we kind of get to a critical mass here, you can stop it and we can kind of see the responses here. Okay. All right. Okay. Are you going to publish the results or no? Because I could. Okay. So maybe I'll just go on. Okay. So let's talk a little bit about, here we go, 19 minutes into the presentation, and we're going to talk about the point, which is reducing fraud. So one of the things, now I don't know if this is going to be shocking to anybody, but one of the things that we have found out is the more that you introduce electronic payments, the amount of fraud and the fraudulent activity as far as the payment's concerned go down. So there's a direct relationship to the amount of electronic payments you can make to reducing fraud. And one of the things that I want to kind of introduce to you, I don't think it'll be shocking, but when I did research on this about 8 months ago, of course I'm a huge nerd, so this is the kind of thing that really kind of gets me excited, is that when you print a check and you send that check out, you are actually sending a vast majority of the information a criminal needs to defraud you. So if you look at this, you'll send out the banking information, of course the check number to let them know where you're going to be, and you send out the routing and the account information. So it's all there on the check, and obviously if you sign the check and put an amount in there, there's a signature in there, and so basically that piece of paper becomes a nice little ticket to to a criminal to use your information for their benefit. Now, let me kind of continue to talk a little bit about this. Hopefully it's not piling on, but it's to give you some additional insight. I go back to my friends at the financial institute that we surveyed for. We had survey for electronic payments, and they did a piece on fraud, and they basically said that 57%, this is the results that they got, 57% of all fraud was perpetrated off of a check, and that a close second were corporate cards. Now I know this just as a matter of fact, but 71% of all fraud comes from some form of T&E, which is around this corporate card. And I'm really excited about doing a live presentation with one of my colleagues who's been in the accounting and accounts payable world for a long time, and she's going to tell a story about how an administrative assistant at an organization was given a corporate card to kind of book corporate functions and lunches, and she decided to run up $31,000 worth of shoes and clothing. And when they called her on it and they said, hey, you used the corporate credit card for your own personal benefit, she was shocked that they were even bringing it up. She thought that was just kind of a perk of the position. So whether you know or you willingly defraud or use your company's corporate card, or you're just like this poor young lady who had no idea that that she couldn't buy anything for herself on it. The point is that corporate cards, T&Es, they get a lot of this. But outside of that, you can see, even outside of that, 57% of all fraud is kind of perpetrated on the checks, and you can see it goes down remarkably when you get into more of the electronic methods. And I'm going to add an additional method that really has very little fraud on it, which is that virtual credit card that we talked about. Now, that same survey introduced the how can you prevent fraud? And you can kind of see, now this slide is awfully wordy, and I apologize for that. I try to make my slides as convenient and easy to follow, but you can kind of look around this, and you can see that, a couple of big things is that, to reconcile daily is a big one, and to, review the internal procedures and processes and controls is another big one. Let me just kind of do a little bit of an aside on this one. I won't stay too long on this, but it's something that I talk and write a lot about. It's something that I like to talk to people about because, when it comes to fraud, one of the kind of most I like to call it an unintended consequence that happens as far as process is concerned. And again, this goes back to the idea of picking and choosing battles, is that if you don't review your processes on a regular basis, we recommend quarterly, but definitely annually. It kind of depends on the size of your company, but if you don't review your processes around who's approving, who has access, and what the process is to kind of do all that, then what happens is your process, and there's got to be a better word for this, but this is the word that I use, becomes pretty soft. Well, let me put it this way. It doesn't necessarily become as soft as, well, what it becomes is it becomes very predictable. And that's where I kind of use the soft word, is because it becomes very, when a process becomes known and very predictable, and if there's no kind of, I know I'm doing a little bit of a soapbox here, but if a process becomes predictable and known, and there's no real kind of, and the folks know that there's not really a good check or balance with it, or knows that, every year we're going to review this, that's when it becomes kind of ripe for potential fraud. Now, I'll just give you a quick story and example. I think stories are important. They stick with you. And that is, we were working with an organization that hadn't reviewed their purchase order process and their invoice approving process and their payment process. And in a long time, they just kind of been doing business because that's what they needed to do. They were growing, they were a fast growth company, and they just really, had other things to do. And so what happened was there was a person in one of their divisions that knew that if she was able to create a purchase order under a certain dollar amount, that it wouldn't get scrutinized heavily, and then that purchase order would be turned into an invoice, and as long as that invoice and purchase order matched, there wouldn't be additional approvals necessary, and then it would kind of be paid and reconciled, and as long as she kept all of that under a certain dollar amount and under a certain frequency, then it wouldn't hit the radar of anybody. And so what she was able to do over the course of time is that she was able to purchase Staples furniture and have that Staples furniture delivered to her home without anybody knowing about it. And so what happened is when we automated that process, it became very clear that the ship to address didn't match any address that was part of their ERP system, and we just matched that up with the human resources records and found the individual pretty easily. But it took digitizing all of that to kind of, and really reviewing that process for all of that come to light. Now, I need to pause here because there are two crimes that were committed in this situation. The first crime is that she stole money from the organization, and the second crime is that she outfitted her house with Staples furniture. And I don't know which one is more egregious, and I know you all are laughing on mute, and I hope more than anything that no one buys furniture from Staples at their home because I've just offended you. So I apologize for that. Back to this. I know my colleague Haley is thinking, just go on. So back to this. And so let me kind of bring this back around and kind of make sure that, 57% of all fraud are through paper checks, the survey has found out. And then the survey went on to say, well, how do you prevent fraud? Daily reconciliations, looking at your processes and procedures. That was what launched that fascinating story that I told you about. And so there's multiple ways that you can kind of do this. Now, here's the thing that I wanted to bring to your attention, and that is, if you automate the payment process and use the thing that I was mentioning to you about the vendor network, and you use software to actually create the payments, approve the payments, track the payments, then you would be able to capture, without any effort, the software itself could capture all of these items right here. And, back to that second point, daily reconciliation, software has the ability to reconcile itself, which is very helpful. Of course, you have to watch it for sure. But this idea of watching internal procedures, and I did a pretty long rant about, this person knew the PO amount, they knew if it matched, and they knew it would get paid, and then if it was under a certain amount at a certain time that it wouldn't get scrutinized, they knew all about the process. The tough thing about fraud is that when you have to persecute an employee or anyone outside of the organization, you have to build a case, and you have to collect your information, and you have to get it all together, and then you have to present that case, and it's got to be overwhelming. And if it's not, you kind of give them the benefit of the doubt and all that kind of stuff. But when you automate the payment process, which is something I'm actually going to show you what it looks like, because I think it's important to kind of materialize the idea. But when you automate the payment process, what the technology does, because it tracks everything that goes on, is it's physically making a case for you every second of every day. I really hope that sinks in with some of you folks. Maybe that'll motivate you to kind of dig into this a little bit more, because I only have a small amount of time that I can kind of give you the ideas here. And one of them is so powerful, but it takes much more than just kind of a few minutes on a webinar to get your arms around this idea. But I hope I'm influencing somebody that the idea is that, when technology is involved, that you can have it watch for certain things, and you can have it report when those certain things happen instantly. And so that's the idea, is that it's building a case for you proactively, and you don't have to kind of go back and build it. So let's talk about a few of these benefits here. So a few benefits with electronic payments is that, one, the software and along with the service reconciles itself every single day to ensure that there are no open charges that are out there. And by the way, we go one step further, because what we like to do is we like to, if a payment hasn't been taken in full, or if there's no indication that if the money is still standing out there, unclaimed, we physically, as part of our customer service loop, we call the individual vendor to ask them what's going on, and we present that back to the client and say, this amount hasn't been claimed for this reason, and that's what the vendor said. And now, unfortunately, it's always kind of come back on our clients because they never had the right amount to pay, and so they would just there were open amounts. Positive pay, you know, I'm not surprised, but because it's fairly pricey, there's a mechanism with all banks. I can't think of one that's an exception. There may be, you know, smaller banks that will allow you that when you create the payment, it'll allow you to send that detailed payment to the bank, and then when these checks or payments, electronic payments clear, if they don't clear with the same information and the same amount, then this positive pay process will kick in, and it'll stop it from clearing, and the bank actually goes after the individual that's trying to clear it. So this is a wonderful thing for fraud if you're not familiar with positive pay. Now, fortunately, in the AvidXchange system, all payments have that included. So, and that's a nice little benefit that folks really love, is that when they use the payment network that I'm going to show you, that they get positive pay with everything. And you know, I was kind of surprised because there's this thing called check washing, and I had no idea what it is. It just shows how naive I am. But we on a very regular basis will catch individuals that'll steal a check, and what they do is they wash the ink off of the pay to and the amount, and then they fill in their own information, and they'll cash that check. But if positive, now we catch this because positive pay says is for this payee, you know, for this dollar amount, and when one of those things are adjusted, it instantly doesn't let that information clear, and it tells us, and we catch these people all the time doing this. It's an amazing thing. But one of the things that I would like to kind of bring to your attention is that you have a secure interface that you work within, and that within the secure interface, all of the check centers are authenticated. I'll give you a little taste of that. But then everything is tracked. And, you know, this idea of tracking and being proactive, so if you look at this with daily reconciliation, positive pay, secure interface, and all of this tracking, and we have the ability to boost electronic payments, it's becoming more and more difficult for someone to just simply take an old check and then turn it into a payment for themselves. So let me kind of show you what all this looks like so you can kind of get a sense of it. So the Avid Pay Network is a collection of 197,000 vendors that have proactively said, here's how I want to be paid. And we work with over 100 bank accounts, and instead of sending a payment file to the printer and the checks print out at the printer, what you would do is you would send a payment file of all the payments that you want to have made to the Avid Pay Network. Now, what I just did is I sent 12 payments into the network, and when I open up this batch, the way that it works is it organizes each of the payments by your bank account using your check number, because that's important for reconciliation, and then it'll go vendor by vendor, and it'll look at the vendor and ask the vendor a very simple question. And that question is, and you can kind of see this over in the column there that says type. It's kind of the second from the left. And so what happens is that the network will determine how the vendor will want to be paid. And this determination is very simple, because if they're in the database, then they're going to be paid on how they want to be paid. And it's usually electronic. 99% of all the vendors that are in the electronic database, the Avid Pay database, are paid electronically. Now, if they're not in the database, what we do is we simply cut a check, put it in an envelope as a service, and mail it. So that's kind of how we figure out if it needs to be electronic or a paper check, because it's either marked in the database or they're not in the database, and that's basically how it works for us. Now, the one thing that, back to this idea of virtual credit cards, is that when I say electronic payment, the one thing that you think about is ACH, but the vast majority, 97% of these electronic payments that are in our network are paid by using this virtual credit card program. Again, it's a one-time use card. So let me give you an example here. This CDW Direct for $447.30. What happens is when that one simple request hits the network for CDW Direct, the network instantly creates a credit card with a unique identifier that can only be a unique number that can only be used one time for $447.30, and it's sent to the vendor electronically. Now, some of these are actually paid by way of phone. So we have a customer service group that picks up the phone and says, "Hey, here's my credit card number for this payment." And the payments are made that way. But a lot of them are presented electronically. Regardless of how it gets to the vendor, they take these funds, and the credit card is immediately destroyed by virtue of it being used once. And if the entire funds aren't taken, because they would have the option to say, well, I'll take $440 or $7.30 left on that, we would be notified immediately. We contact them for a reason and report that back to the client. But the whole idea is, so back to this whole idea of fraud, that when you put these things on these cards like this, and it can only be used one time, and we send that information to the vendor, and see, the wonderful thing about using the virtual credit cards, and I'm probably getting on my soapbox again, the wonderful thing about using these virtual credit cards is that it's leveraging an already established network. And so what that means is that you don't have to set up like an ACH relationship with them, and you don't have to set up a anything that's and like, by the way, if the unlike ACH, if it changes for the vendor for any reason, that's something that happens with the credit card company. So there's a lot of convenience in using these cards. I'm sorry, I'm going back to this a little bit, but the long and short of it is that can't imagine it. Well, you can imagine using these credit cards, getting rid of the payment. This is what we're trying to do. This is kind of my last point, and that is we're trying to take the entire process, and I didn't talk about the invoice process much, but we're trying to take it from the very beginning to where all these slashes are representing areas that we're putting either service or software in place to free up time, so you can not only have a faster process and spend less time with it, but you can have a more secure process, because we're leveraging. Here's the number that I want to give you: is that every time whenever payments are sent to the network, 47% of those payments are applied to one of those credit cards and other electronic payment methods. Like I said, there are 5 of them in there, and that's 47%. That going back to my original point, when you pick and choose your battle, that seems to be the toughest piece, is getting over. The industry average is about 9%. But we're averaging 47% because of all of that customer service and all of that calling. So here's what a customer said about it. It says you can't even assign a value to the efficiency, but it's worth a lot more than the monetary savings of $72,000 a year, which they received. Now that I have all the information that I need right at my fingertips, which is one of the great things about automation, I can focus on cash forecasting, scheduling payments for ideal cash management. So that was Chip Vaughn, good friend of mine, CFO at the Wilton Companies, and I tell you, he's got an important point. Now I'm going to make my last point here, but I'm going to put the poll up, and so if someone would just kind of launch that, and we'll kind of cover any questions at this point. But let us know. Do you want to learn more about this? Do you want to see maybe a more suitable demonstration? Dig into exactly how it works. By the way, I'll mention this. This could be kind of a shocker, but I'll kind of leave you all with this, and that is, when you apply those payments to the virtual credit card, you'll get a rebate, just like using a corporate card or a P card, and these rebates can get significant. But I didn't want to talk about that too much on this presentation, but there's so many side benefits to it, as it pertains to fraud. So where do we go from here? Just kind of fill that out, and then when you're ready to close that poll, you can go right ahead whenever we kind of have a critical mass. And let's do this. So just to kind of summarize, what we're trying to do at AvidXchange is we're trying to put as much software in place as we possibly can, layer that with as much service as we possibly can to free up as much time as we possibly can, like Chip's statement said earlier, so you can use that time in other places. Like I said, pick and choose battles. But there's some incredible fringe benefits to this, and one of the biggest fringe benefits is this idea of reducing fraud. So when electronic payments go up, and okay, we can close the poll. You don't have to post the results. You can just close that, and we'll kind of start getting to the question. Thank you so much for that. So we're at the point where I want to kind of conclude here, but the whole point is that one of the remarkable fringe benefits to automating and making as many things electronic as possible is that you really put yourself in a situation to have the technology watch the people in process and report on any anomalies as they happen, which not only does that reduce fraud, but it actually reduces the desire to defraud. When people know that they're being watched, they do different things. They just can't get away with stuff. And the other thing about automation that's so good as it impacts fraud is that there's another idea that if you put your permissions and processes together in such a way, which by the way we really concentrate on this, so when you really put your permissions and processes together in such a way, you have the ability to ensure that if someone wants to defraud the company, they have to get other people involved. Auditors love to call this, and risk managers love to call this collusion. And the more that you can make this group bigger, the less likelihood you have of folks actually trying to collude. Getting together. The more people you got to recruit to defraud, the less it'll happen. Okay. So Haley, I don't know. Haley, are you the question answering person? Are there any questions in the queue that we need to answer?
Hi,
Or is it
Chris.
Adrian?
Any questions right now?
I'm not seeing any questions, but I did have a question, Chris. I noticed that there were quite a few Sage 100 partners. There's also Sage 300s and Epicor customers on the line. What types of ERP systems have you interfaced with, and what does a typical implementation look like? What's the process?
Great, good question. And all those that you listed off are systems that we're currently integrated with, and we're integrated with over 100. I've kind of lost track, and it's everywhere from Oracle, SAP, on down to QuickBooks, Peachtree, and kind of mentioned. But we seem to do a lot in kind of this Dynamics, NetSuite, any Sage, any level of Sage, we'll kind of operate right in there because that has a tendency to reflect a lot of who our clients are. They're these mid-market companies, and so we kind of do a lot with them. Typical implementation is about 45 days. That's all in. The payment process is a little quicker than that. It's usually about 2 weeks, depending upon the ERP. We've done the payment process in as little as a week, but with the 45 days on everything, we have a guarantee that we put to it. So that means that if you're up and running within 45 days, we give you 20% of your implementation fee back. Now that's an important thing for us because we want to let everyone, especially on this call with partners, know how serious we are about not putting another 6 months implementation on your plate. Okay.
And I just want to remind the audience that there's 2 buttons next to your name on the webinar pane. There's a question mark button and a hand button. And if you do feel comfortable in raising your hand, I will attempt to unmute your line and we could speak live. If you do have a question, just to remind you, click on that question mark button. A dialog box will open up and you can key in your question and we'll announce the question so that Chris can answer. And if we don't have any more questions, Chris, I just had a quick question myself. It seems like this, sure, in addition to all the other automation that this serves, it seems like this would drastically speed up fiscal year end and tying your books together, and in the case of a possible audit.
Yeah.
Do you come across
Absolutely.
those opportunities for time savings? And
absolutely. When we automate the process from end to end, from the invoice to the payment, that's our version of end to end. Of course, there's purchase order on that too. We kind of consider that all part of the invoice. But when we automate it, we generally free up about 8,500 hours a year. And some of those hours are hours that are spent at the filing cabinet. We'll stop that. There's no need for filing cabinet. But I think it's so hard to kind of, extol all of the virtues of automation, on a single 45-minute call, but you've dipped into. We've actually had people, because their audits were so robust, and they said not only are we going to have this level of detail, but you have to provide this backup with invoices or canceled checks or anything like that. It becomes like we've had companies that have decided to automate on that alone. And so we've had lots of stories with folks where they've gotten rid of the filing cabinets and they have these electronic logins, and we're fortunate because we're software as a service. There's nothing that folks need to buy or maintain or install. It's just connection to the internet. And so what they do is they give the auditors a login that the login is so restrictive they can only search for certain things, and if they wanted to, although a little piece of me dies every time, they can print it out if they wanted to. But the point is that we don't charge we charge transactionally. We don't charge by the login, so they're having their auditors go in and do this work, and they don't have to come to their office, and they don't have to use any manpower or woman power to find that backup. So that's a good point. I mean, there's so many things that automation impacts and touch. The crux of it all is, we free up a lot of time.
Well, thank you so much, Chris, for your wonderful presentation. You obviously have a lot of years under your belt in this area.
There you go. We're getting the veteran thing back. It's exactly right. It's my saying. Absolutely.
I'm accentuating.
Yeah, exactly.
So, well, thank you, Haley and Chris, for joining us today, and everybody else for being on the line. We know an hour of your time is hard to come by, so we really appreciate you spending it with us. And we will be having another one of these types of webinars just on a different topic in the next few months. So stay tuned. You'll get an invitation for that. I did record this webinar, and I believe Haley will follow up with you with the recording in an email follow-up with all the proper contact information so you can reach out to AvidXchange if and when the time is right. And thank you so much. Chris, would you like to close out with any final remarks?
Final last words. We want to help. You have any questions, let us know. And Adrian, thanks for the opportunity.
Oh, it's my pleasure. Thank you. All right, everybody, take care. Have a great day.